Imagine watching markets open quietly after weeks of chaos. No major panic, no violent sell-offs. But look closer, something's changing under the surface. The US just paused tariffs on semiconductors and key electronics. On the surface, that sounds like good news. Apple jumped 4%, not surprising since most of its iPhones are made in China. Automakers like Ford and GM also spiked. There's talk that exemptions could be extended to auto parts too. But then Trump comes out and says no country, including China, is off the hook. He reminds everyone that tariffs on chips are still coming. This isn't a pivot, it's a pause. Behind all this, the bond market is speaking loudest. Yields on the 10-year Treasury fell 13 basis points. The dollar is breaking down, nearing a 3-year low. China is likely selling U.S. debt to support its own currency, and that's pressuring the dollar in one of the most illiquid stretches we've seen. Let me explain how that works. If China is selling U.S. government bonds or U.S. treasuries to support its own currency, the yuan, by selling those bonds, China gets U.S. dollars, which it then uses to buy yuan in the market, helping to keep its currency from falling too much. But this move has ripple effects. When China sells treasuries, bond prices fall and yields rise. At the same time, dumping bonds adds downward pressure on the U.S. dollar, and because this is all happening in a market with very low liquidity, where there aren't many buyers or sellers, even a small shift can cause big swings. That's why the dollar is weakening and volatility is quietly building beneath the surface. Defensive sectors like utilities are quietly outperforming. That usually means investors are getting cautious. Trading volumes are thin. Liquidity, even thinner. Top-of-book liquidity for S&P 500 E-mini futures has dropped to just $1.8 million, far below the historical average of $13 million. That means there's much less buying and selling power at the best prices. Bloomberg even noted it dipped to $2 million recently, the lowest on record. When liquidity is this thin, even small trades can move markets sharply, making them more vulnerable to sudden shocks. Under the hood, hedge funds are still cautious. Asset managers are net sellers. There's no real conviction in buying yet. Everyone's waiting for clarity, but the longer they wait, the harder it becomes to step in. Volatility is easing, but that doesn't mean safety. It means people are holding their breath. VIX futures are down, and big bets are being placed quietly, like someone scooping up 40,000 June VIX puts for just 12 cents. That's not fear. That's someone hedging for a shock. We're in a weird window, roughly 90 days, where trade policy is being shaped tweet by tweet. No one knows where it lands. But uncertainty like this, it crushes long-term confidence. When companies and households can't plan, they don't spend or invest. So, if you're wondering where the next shock might come from, don't look at CPI or GDP. Watch jobless claims. If that starts to tick up, the whole market narrative shifts. This is a market on edge, calm on the surface, fragile underneath, and if it breaks, it won't be loud, it'll be fast. This is where the smart money listens. No fluff, no noise, just raw market flow. Subscribe now.